Good afternoon, ladies and gentlemen, or good evening, wherever you may be. I am the Crypto Crow, and today we're going to do a pretty significant lesson in Wyckoff accumulation and distribution schemes. I've done videos on this in the past, and you know, they a lot of these kinds of videos, people look at indicators kind of like underwear, I guess. They use them a couple times and then they throw them away. Maybe not everybody does that. So we're actually going to be covering some of this stuff and going into this because it's very obvious to me that the Wyckoff schemes have been playing out over and over for quite some time. And so we're going to go over a little bit of history. We're going to go over what makes the Wyckoff popular, a little bit of how it was created and what everything means. And then we're going to look at today, what's going on in the market today, what makes sense, what is to be expected. And you know, if you've been watching my videos lately, as I've been referencing Wyckoff in my charts, you might be a little surprised by what I present because I may have it wrong. And I'm going to explain to you why. But first, we're going to go into a little bit about it. So basically, the Wyckoff schematic was created by Richard D. Wyckoff, who lived between 1873 and 1934. And ultimately, he created this system of trading by watching people like J.P. Morgan, who was it, Jesse Livermore, and others. And he basically created this this collection of trading practices, things that he witnessed the big boys do, you know, as they were kind of trading or even, quote, maybe manipulating the market in some ways. And ultimately, it's a system by which the major whales with major money and assets are trading the market to take advantage, ultimately, of the retail investor. I mean, that's ultimately what it boils down to. That's why they call it dumb money. You've got smart money who are making the moves that are creating this cause and effect. And then you've got the retail investors who are just trying to play catch up. A lot of them end up chasing candles, kind of, you know, firing it off in the dark, not really sure what's happening. And that's kind of the idea of it, is to kind of keep you chasing your tail but not fully understanding what's happening. Now, I will also say that nothing in crypto trading, especially crypto trading, is 100%. And as a matter of fact, while I've been using Wyckoff for quite a while, on and off for years, even these patterns can be broken. And so what I'm actually starting to do now, which I will end up doing a follow-up video about this later on, if you subscribe and like the video, maybe leave some comments or questions, and I'll address those in a follow-up video. But what I'm ultimately doing is I'm experimenting with other indicators in conjunction with Wyckoff to see if I can use other indications of market cycles from the past to dictate where the Wyckoff may start ebb and flow throughout a schematic, which schematic is most likely taking place, and basically get even a more you know, just a more confluent system of a variety of different indicators, because all an indicator is it's basically one point on a map, right? I mean, and that could change. And so you want to have multiple points of confluence before you make any significant trade for the most part. But this pattern basically trades on a multitude of laws, okay? And we're going to start going into these first three major practices before we kind of dive into the actual patterns themselves and start dissecting them a little bit. So here we are, the law of supply and demand, obviously, which everybody is familiar with. Okay. It's the whole reason why Bitcoin and the halving, you know, every 4 years, it's why everything is a cycle the way it is for the most part. It's basically the law of supply and demand. The first law in the Wyckoff method, the law of supply and demand, primarily assumes that if the demand increases, the prices will increase. But if the demand is lower than supply, the prices will decrease. An increased price indicates that more traders are buying, and the decreased price indicates that there are more sellers than buyers in the market. Wyckoff method involves a simple charting method to determine the effects of the cause. In simple terms, Wykoff introduced useful techniques of representing trading targets primarily based on the duration of both the accumulation, the gathering of coins, basically, you know, kind of like a bear market cycle when you're trying to accumulate and bring all of the money into your pot. And the distribution periods, which is basically, you know, where they're looking for exit liquidity to drive the market up while they're basically dumping. As a result, a trader can determine the extension of market volume after breaking out of the period where price breakdown is expected to pause, or the trading range. Now we're going to go into number 2 here, the law of cause and effect. This is basically, you know, where they're messing with your head. The law of cause and effect assumes that certain events cause the non-random difference in supply and demand. In other terms, the distribution period leads to a downtrend, and the period of accumulation results in an uptrend. Traders use this as a filter to set their price targets. This is one of the most important laws described by the Wyckoff method and is regularly used in financial markets. Precisely, the law of cause and effect indicates that the demand is higher than supply, since the prices increase as it shows that more people are buying the coins. On the other hand, if demand is less than supply, prices fall, indicating that fewer people are interested in that product. So, you know, and this is also played significantly by market makers. If you really want to learn about market maker trading strategy, there is a woman that is phenomenal with it. Her name is Trade Travel Chill. She has a fantastic course online. She's an Aussie. She's from Australia. She has an accent. I love it. But she does fantastic work. And she's very straight up too. She doesn't get emotional. She looks at the numbers. She studies heat maps to understand where price action is likely to go. She charts it all out, and she's really solid. Honest to God, she's probably the most I was going to say the most impressive female trader I've seen, but she's honestly one of the most impressive traders, period, that I've seen in terms of her knowledge, her interpretation of the market, and the tools that she utilizes to gather data while she's making decisions. So you definitely want to check her out. So keep that in mind. Now, I don't know if she does much with Wykoff, but her methods are very much specific to market makers. She wants to know what the market makers are doing. But the thing of it is a lot of market makers utilize Wykoff accumulation, distribution, all these different schematics to do exactly what it was designed to do, to basically take your money, to liquidate longs, to liquidate shorts. So keep that in mind as you continue your research into trading. The law of effort versus result. The third law in the Wyckoff method, the law of effort versus result, argues that differences between price and volume indicate a variation in the market trend. If there is a harmony between volume and price action, the trend will continue. However, if there's any difference between price and volume, the market trend will eventually stop or change its direction. For example, the Ethereum market strengthens with a higher volume after a long bear trend. The higher volume indicates a strong effort and low volatility. So despite the continuous variations, there are no more notable price drops. These types of trends are a clear indication that the downtrend is over. So that's definitely what we need to look at as we're looking at the price right now. Are we going to continue in a downward trend? What phase of accumulation are we in right now? We're in one of two. There's no doubt about it, because you're looking at one. This is a previous accumulation, and this is a confirmed accumulation 1 pattern, okay? Now, you can see kind of the ebbs and flows. You can see where it begins, and we're going to dissect this a little bit. So we're going to go into the first one. And another element of this whole Wyckoff system is basically built around the composite man. Basically, when you're trading and you're charting and you're playing mind games with yourself and you're getting emotional, The reason why it's so frustrating is because, you know, a lot of people, even a good friend of mine, he's like, Jason, I'm buying in right now. He's like, just watch. He's like, as soon as I buy, the price is going to drop within 15 minutes. I guarantee it. And what's funny is he's right, because he's very, very emotional. He blows my phone up all the time with a million questions. He wants me to tell him, like, basically every breath I take, because he wants to feel confident. And sometimes I just let them stew it out, and I'll just say, relax, because the market, while it's volatile, always seems to come back to where it was at one point or another. It never seems to just hit one spot and that's where it's at forever, right? So there's a consistent ebb and flow to the market on a regular basis, which is why I don't chase candles. Because typically when you're chasing candles, once that buy volume has been, you know, fulfilled, that's when we start getting these pullbacks. And there's typically always a pullback after a run up. And vice versa. We get oversold quite easily as well. And when we've sold too much, then the buyers start to kick in. And that's what creates this ebb and flow to the market. So as we're looking at this, this is actually a Wyckoff distribution. I'm sorry. So this is a distribution. Down here is the accumulation. So this is basically a perfect cycle. What's the time frame on this? So 2021. Okay, so this is all within the same year. And these are daily candles here that we're looking at. So initially, we started off with a Wyckoff distribution that sold off into an accumulation pattern. This accumulation pattern is why people like Warren Buffett and others say you buy when there's blood in the streets, because this is the blood in the streets. You can see it right there in red. This is where blood is in the street, and it's hitting basically all-time lows or new lows for the cycle. And that is when it's, you know, you hit that spring and boom, away we go into another bull cycle. And then we do our thing here, and then we end up in another distribution cycle, which is basically where, you know, there's plenty of exit liquidity. A lot of people are up here thinking, oh, the price is going to go even higher. It's going to go higher. And then we distribute. So, and then we start to dump. And then we can go sideways for a while before we head into an official accumulation scheme. Now, this was the double peak of the 2021 market. This is where we were. And if you chart those out against the schematics of Wyckoff, you can see that they measure up almost identically. Very, very, very solid. Now, here we are entering into current market times, right? We were basically up here. We were sideways for a little bit after we hit a distribution phase. We went more or less sideways. Again, this is on a daily candle, and we started to come down and come down and come down. All right. And then we ultimately, about here, we started seeing the price where this was the first bottom, right? And everybody was like, oh, the bottom is in. It's like 17,000 something. We wicked into it. And that was all she wrote. A lot of people were like, oh my gosh, we're going to the moon from here. And of course it does. It turns around, and it went all the way back up to 23,780. And then it turned around again. And then we just went pretty much sideways and up a bit until we got to around 25,000. And boom, we came all the way back down to a secondary test in the phase B of this accumulation pattern. And I'm going to go into what these ST, AR, all this, I'm going to go into what these mean in a minute. But I wanted to basically show you what's happening, because once you learn these patterns, there are 4 different schematics. And the trick sometimes is figuring out which one is happening, which is what I'm looking at them now, and I'm thinking, we could be in an accumulation 2 pattern, not a 1, at which point we may not see this spring. Because when I charted this out, we went sideways for a little bit here, and then we got another, I wouldn't call it a peak, but we got another bump up where we were basically testing a lot of resistance up here. Then we came back down, and then boom, we tested it again. Now, over the last several days, I've been basically saying, okay, we are obviously in a Wyckoff accumulation pattern. And you can look back on the videos over the past week or so where I've talked about this. And I am one that thinks that we haven't seen the final bottom yet, that we could, in fact, get a new low. I could very much be wrong. The bottom could, in fact, be in. It is what it is. We'll figure it out when we get there. But I have been trying to figure out what is most likely. The majority of indicators in the market right now are basically pointing to the bottom having hit already, and we're basically going to start moving sideways and up until we get to the halving in 2024 and take off. And you know, it's very likely we could end up somewhere around $35,000 range by like April of 2024 as we run into the next halving, and then we'll get a little spill down before we start our trajectory up. But in the meantime, I'm trying to figure out when is the best time to basically load up. And so as I'm looking at this accumulation pattern, I'm coming up here and I'm thinking, okay, we are at a point where, well, so down here, I said, you know, I see us getting a new low from here because we're in an accumulation pattern. And unless we were to close above like 25.2, 25.3, somewhere thereabouts, in other words, we have to close above this here, which is $25,258. If we close on a daily candle above this line, then this accumulation pattern is likely very much rejected, and we're not going to see a new low. However, there's another caveat to that I'm going to share, because as we are working towards this, we're basically seeing that there's another pattern that this could be. And I'm going to show what that is right now. So this is the accumulation schematic 1. This is what I've been expecting us to be in, what I have charted out, and what I have ultimately, this is basically what I have mapped out, where you can see that we might be peaking out here, and then we can get a new spring, which this new spring would be a new low, and there we go. So that's it. So what I think we might actually be looking at is this. Now, if I flash these two, what is different? One has a spring, the other doesn't. So in an accumulation schematic 2, you can see this LPS, LPS, SOS, and then back up. Now, everything up to this point where we see the LPS in phase C, everything is identical. Everything is identical. The only difference is, are we moving sideways or are we getting a new low? And that is the question right now, because either one of these could be playing out right this moment, and I'm not sure which is which. So that's what I've got my eye on. We're either going to get a new low, or we could basically come down and retest somewhere around 17.5, and then that's it. But either way you slice this cake, we're still probably going to be coming down somewhere between 17.5 and 18.5 before we go back up. And that's what I am charting out at the moment. Now, you can also chart these, which are the distribution schematics. You've got distribution schematic number 1. You can pause the video if you want to use this as a reference. And then you've got distribution schematic number 2. Do you see the difference? One has a new peak, a new high, the other one does not. And these are the tactics that are ultimately used to mess with people's minds in a nutshell. And so that's ultimately what we're looking at. Now let me get rid of these real quick. There we are. So that's basically what we're looking at. So we're gonna dissect some of the terminology a little bit in here. I've got my reference materials up. There's too much information to have all at once. But we're gonna dissect some of the key symbols in here and what these mean. And then you should be good to go. There are books. I have books on Wykoff. I've got a 2-volume set that's actually really, really informative, because just understanding the Wykoff schematics is only part of the battle. There's a much deeper element to this that includes volume and other indications. Volume can really help when deciding what direction these schematics are going to play out in the future tense. And so that's a whole other element of Wykoff, and there are many others as well. But when you start an accumulation pattern, okay, such as the one we're in, you're going to see the price, it starts all the way up here. We go sideways for a little while and we come all the way down here. This PS stands for preliminary support, where substantial buying begins to pronounced support after a prolonged down move. Volume increases and price spread widens. signaling that the down move may be approaching its end. So you can see the significant down move. We got this preliminary support, and like it's explained, that downtrend stopped. We went sideways for a little while, and then we even got a little bit of a tick up. Okay, because generally when we see a significant move to the downside, we get a little bit of a reversal. From there, we moved all the way down to the selling climax. Okay, the selling climax is basically what it means. People are done selling. Okay, people want to buy and move the price up a little bit, and it's going to go a little sideways. The point at which widening spread and selling pressure usually climaxes, and heavy or panicky selling by the public is being absorbed by larger professional interests at or near a bottom. Often, price will close well off the low in a selling climax, reflecting the buying by these large interests. So that's basically what you're seeing here. Okay, this is a point where, you know, hey, the retail traders, they're selling because they're like, okay, this price is going to keep going further down. I've had enough. I'm losing my money. I can't take any more. Oh my gosh, this is the selling climax. A lot of the people have already sold by this point, and they're selling into the hands of the institutions and those that are in the know. And so those guys start buying, which starts moving the price up a little bit. As they're buying, you get what they refer to as an automatic rally, which is AR. In an automatic rally, they occur because intense selling pressure has greatly diminished. A wave of buying easily pushes prices up. This is further fueled by short covering. The high of this rally will help define the upper boundary of an accumulation TR. So you can see we get that automatic rally, and then what happens? After this selling climax, you get a secondary test. Okay, that's ST. You've got the secondary test, and then what happens after you get another, like a local bottom? Well, you get a reversal, and then we go up a tick. Now, once we've established this kind of new or high in the pattern, well, of course, we're going to start moving down, and a lot can happen in this area, but ultimately, the lines match up, and you can see if you're comparing them chart for chart. So let's take a look. I'm going to make it small though, but I'm going to bring this in. I'm going to make it smaller, and you can hopefully compare this. Where is it here? I want the accumulation. There we go. All right. So hopefully you can see this a little bit. We're going to put this above my head, but you can see how clearly this stuff ultimately matches up. And you're going to have some deviations here and there, but they're not going to break the highs and lows of the pattern overall. And so it's very easy, especially in hindsight, to jot these patterns down. The tricky part is doing it live and trying to figure out which direction the price is likely to gonna go at any particular point in time. So for me, what I like to try and use these schematics for are dictating highs and lows of a particular phase in a market cycle. And that's ultimately what I'm going to, and then, in conjunction with other indicators that can help establish a confluence between multiple indications of potential price action. That's ultimately what I like to do and what I'm looking at. So from here, you can see that the price continues to move down and it goes sideways for quite some time. And then we get a hard crash. Okay. This went from 21.5 all the way down to what many believe was the bottom, the official bottom of this market at around 15.5. Okay. We might have wicked below, and it was somewhere around 15.5. This was the secondary test in phase B of the overall schematic. You can see phase B above my head. It's a much wider range, and there's a lot more that can happen in this phase B. But the secondary test is when the price revisits the area of the selling climax to test the supply and demand balance at these levels. If a bottom is to be confirmed, volume and price spread should be significantly diminished as the market approaches support in the area of the selling climax. It is common to have multiple STs after a selling climax. So you can have more than one of these. And ultimately, it looks like we do, but it doesn't really matter ultimately that much. I just basically charted it all straight to where the peak was. Now, looking at the accumulation pattern more, what do you see? Well, we see that This area here, actually, I'm gonna have to show you on the chart because I can't really point at it on, so I'll line this right up. So basically right where that first point is about where we're at right here. Okay. Now from here, we're going to go down. How much we go down, I don't know yet. We could either hit this spring. If we're in accumulation 1 pattern, we can create a new spring, which will launch us into another test phase, and up we go. And like I've said in other videos in the past, we could basically spread this path out to line up directly with the next halving, somewhere around 30,000 or so, or we could get another distribution phase after this accumulation and go from there. But I'm guessing this might be a more of an elongated schematic, but if it is, this whole thing would have to play out over the course of basically a year. I don't see that happening. I can see this concluding and then us basically sitting sideways for 6 months before a new pattern gets introduced to the market. So that's why I said, unless we close on the daily above this $25,200 mark, we're not going to, which I don't think we're going to do anytime soon. I think we're going to continue moving down. But the question is, which I'm going to be waiting for confirmation with, and I'm going to try and figure out other ways to decide this. Are we in a spring pattern or are we not? And this is ultimately the alternative to that. We're not going to get a spring that's going to launch us up. We're not going to get that new low. We're just going to go sideways for a little while. So the point that we're looking for here, and that goes into the phases. Let me see here. Where am I? There we go. All right. So if we end up going sideways instead of getting a new spring and a new low, we're going to basically be in this LPS zone, okay? This LPS zone is the last point of support, the low point of a reaction or a pullback after a SOS. Backing up to a last point of support means a pullback to support that was formerly resistance on diminished spread and volume. On some charts, there may be more than one LPS, despite the ostensibly singular precision of this term. And that's ultimately it. So one way or another, we're going to be going down, and it's just a matter of how much. Are we going to get into a new low, or are we just going to end up in a new last point of support and then go from there? But that's ultimately Wyckoff in a nutshell. Okay. And there are more elements to this, and there's more you can dive in. Check the links below for some very good information on Wyckoff accumulation distribution. There are some really good books that I could suggest. Let me know in the comments below if you're interested. If you do want some books on this, I can link you to some. I won't even bother with affiliate anything. I'll just point you to some of the books. This is what I'm using. And I'm going to continue trying to add indicators to this that can help me establish confluence that I can effectively act from, even on like a 4-hour time frame. The daily time frame, from what I've seen, is definitely the best, because the higher the time frame you're trying to establish signals and points of interest on a chart, the higher the time frame, typically the more accurate they are. So hopefully this video helps you at least get a pretty decent understanding as to why I utilize Wyckoff, why I think it's very key, very important. And listen, you can back test the Wyckoff patterns against historical charts and see if you can pick them out. See if you can chart them out. See if you can cross reference an accumulation 1 pattern to an accumulation 2 pattern. What are the differences? What are the differences in volume as you hit each ebb and flow? And that should help you really kind of decide what might be happening as you're moving forward in an unforeseen market. When you're trying to map out something like I've done here, basically mapping out an accumulation 1 schematic when it could end up becoming an accumulation 2, but we probably won't know until the price is somewhere around 17 or 18 or 19,000 anyway. But the point of the story is that at least I have an idea, and I have a pretty solid foundation that tells me it's likely the price is going to come back down to that point. So at this point, even if I get a confirmation and I'm able to really average in at $20,000 or less at Bitcoin's price, that's good for me. At least this charting schematic helped me understand that that was likely an outcome in the not so distant future, so that I can start planning ahead for that. So hopefully this video helps you. I hope my video finds you well. If you like what I'm putting out here, make sure you hit that subscribe button and the alert notification, and drop a comment. Let me know what you think or any questions you have. And until next time, guys, enjoy your weekend, grow your coins, and I'll see you again very soon.